Hello guys, welcome back to our Freebie Friday video. It's Sade here, and today's video is going to compare the home equity loan with the home equity line of credit, because I've been asked to do a quick video for that topic. The home equity loans are generally similar to a regular mortgage. They have fixed rates. It's a fixed amount that you borrow, and it's based on the equity that you have available in the home. Typically, you can only borrow between 80%, maybe sometimes 90% of the available equity. And the equity, of course, means that the difference between the value of your home and how much you currently owe on it. So let's say you already have a first mortgage, and you already paid that first mortgage down to about $50,000, and the property itself is worth $300,000. That means you have $250,000 worth of equity potentially in the home. The lenders will do their appraisals, their own appraisals, before coming up with the figure that they think they're comfortable with as far as the equity goes. So just keep that in mind. So usually about 80% of the equity you can borrow against for a home equity loan. The rate is going to be fixed, so you'll know what to expect, and your payments are fixed for the most part because you pay the same thing every month until you pay it off. So it's usually for similar terms like the regular mortgages, maybe 10 years, maybe 20 years, could be 15 years, something like that. On the other hand, the home equity line of credit actually works more like a personal loan or a credit card. So it's a revolving kind of credit, and it does not force you to borrow a specific amount, but there is a limit, almost like a credit limit. So let's say the amount that you got approved for based on the amount of equity and other considerations is $100,000. You do not have to borrow $100,000. What you typically do is you draw on it as time goes on, as you need the money. So you can use the money for anything that you want. Same thing with the home equity loans. You can use the money for anything that you want. But in the case of the home equity line of credit, you have more flexibility because you don't have to borrow the money if you don't ever need it. It's just there just in case. There is a period of time for the home equity lines of credit where you do the drawing, which is taking the money out. In that period of time, you typically don't pay back on the actual borrowed amount, but you might pay a small minimum payment every month. You'll be required to do that, and that's typically for the interest payment only. And then after the draw period ends, which is typically about 10 years, you will then either have to pay it all off at once, whatever amount you did actually borrow, plus interest, and you pay it all off in one balloon payment. In some situations, if you get a good deal on the home equity line of credit, you will be able to have a repayment period that would extend for maybe another 5 to 10 years or 20 years. So it will then look more like a regular mortgage. The other big thing about the home equity lines of credit is that the interest rate is not fixed. So the amount borrowed is not fixed, but there is a limit to the amount that you can borrow. And then the interest rate varies based on the U.S. Reserve's prime rate out on the market. So it's going to change as time goes on, but there is a cap on the interest rate. Usually make sure that you keep an eye on what that cap is. So no matter what, sometimes it's still a good deal if you take a home equity loan or a home equity line of credit, even though the rate is not fixed. It's still never going to be as high as the interest rate, for instance, on a credit card. So you'll actually end up maybe having a good deal in the end. But be very careful. Make sure you know your numbers and make sure you know what works better for your situation. If you don't need the whole amount, then you may not need to borrow on a home equity loan. And the qualification requirements are pretty much similar. So you should be able to qualify for either or based on your equity in your home. And ability to repay it is also looked at, but it's not a big deal usually. You can use the money, like I said, for repairs to the house, renovations, for the tuition for your students, for your children's school, or for medical bills or personal reasons. So there is no limit to what you can use it for. But of course, if you don't have to borrow, don't do it, because it's always better to be debt free if you can. So so that you're not putting your house at risk, because sometimes the foreclosures would happen if somebody is not able to repay. So when you're negotiating on a home equity line of credit, make sure that there's no balloon payment requirement after the draw period ends. And remember, the draw period could be 5 years, it could be 10 years. But also try not to draw more than you need, and try to make more payments during the draw period than the minimum payments. Try to make higher payments instead of just the minimum payments. So for example, as far as interest rate goes, I've seen some that have a cap on it at 12%, which I think is still pretty high. But when you compare it to the interest rate of a credit card, for instance, the average credit card's interest rate is about 17%. So you could actually take out a home equity loan or use a home equity line of credit to pay off the higher interest rate debt that you have out there. If you're very disciplined about it, you can use that to consolidate your debts in that way and then pay everything off. So that's my quick review of the differences between the two. I think for the people that need more flexibility, home equity line of credit works great. For people that like everything to be less complicated and just predictable, then I would say the home equity loans will work better. So if you have specific questions about your situation, remember you can always drop us a note on the website or email directly to the office, or call us, and I'll be happy to answer that. If you have specific requests for video topics, just drop a note down below and I'll cover those as well. Thank you, and I'll talk to you next time.